Good morning, everyone. Joe Mass here. It is July 18th, and I want to give you a quick Q2 update. Again, these quarterly updates are a little more detailed and longer than our normal monthly and weekly videos, so I apologize in advance. I am a clock builder. I do know you want to know what time it is, but a lot of these slides will be familiar for you, and that's because we look at the same things over and over and over, and we continually do the research to understand how to reposition the portfolios and navigate the markets. So let's get started. Okay, this is my smiling face. Most of you are familiar with me. I'm your Chief Investment Officer. I've been doing this for 30 years, and I just like to take the opportunity to thank you for letting me serve you and manage your money and give you updates. Okay, let's dive into this slide. You've seen this before. We're still in a battle of the bulls and bears, risk on, risk off. We still have the macro and geopolitical risks that are out there. And so that is influencing investors' decisions. There's a lot of people still in cash and risk off investments. Of course, those have been out of favor this year. You are maintaining diversification. Bonds are doing much better than they were last year. But again, risk off assets and lower returning strategies are not going to provide you with those real returns compared to the other side of the coin, where we have equities. So again, this year, equities have been very resilient. We have growth over value. The market's off to a great start. Risk on assets are definitely in favor, and the returns have been higher. The problem is that most people are not willing to go back into the market. There's a lot of cash on the sidelines, and so the risk remains. And so a lot of people are remaining hedged. We're hedged in some of our portfolios. We think that's still prudent. We're not out of the woods yet, but things are looking better temporarily. And again, they can change on a dime. Now, this battle between risk on and risk off and this emotional roller coaster that you're on, why you're feeling that is that you've been forced to take more risk. And what we're looking at here is that in 2001, an investor was able to get a 5.6% return with taking 3.8% risk. In 2011, in order to maintain that same 5.6% return, we had to introduce 55% equities in order to maintain that. And so therefore, risk went up over 10%. In 2022, look what happened. To maintain that 5.6% expected return, we had to add high yield bonds, international equities, emerging market equities, real assets, hedge funds, private equity, alternative investments. So we were forced to take a lot more risk and introduce more asset classes to the portfolio to maintain the same expected return from 20 years ago. And then, of course, risk went up. So that's what you've been feeling. You've been feeling that in order to maintain those portfolio returns, we've had to take more risk. In addition to the down and upside volatility has increased. Okay, you've been able to maintain the return, but you're taking more risk. So what we're looking at here is that in 1990 to 2000, the ratio between the volatility in the markets on up days versus the volatility in the markets on down days was 1.17. And today, 2010 to 2022, that ratio's increased to 1.76%. So you've really been forced to take more risk, and that's what you're feeling. Let's talk about cycles. So the reason that we're a dynamic and adaptive investment managers and the way that we manage money changes continuously is because the market changes, right? It's cycles, and this is normal. We expect this. And so you can see starting at the left that, hey, if we're at the bottom, you're going to be really bullish, right? And you're going to ride that expansion up. At the peak, right, you're going to get really bearish because you're expecting that downside to come, that recession. Then you hit the trough, you become bullish again, your recovery into the expansion to peak, and cycles over and over and over. So the difficulty here is that your emotional cycle, right? When do you feel really good and excited about investing? That's when you're at the peak, right? You've run that expansion up, you're making money, everything looks great, you're really excited about the market. Your emotions, right, are disconnected from the economic cycle, because at that point, that's when you should really be getting more bearish and becoming more conservative in the portfolio, right? When do you feel at your worst? Well, that's at the trough, right? You feel your worst after you've gone through a bear market. You never want to look at another stock or bond again. Okay, you said, I'm done. I can't handle any more emotional stress. Well, unfortunately, that's exactly when you should be the most bullish. And so you want to buy low and sell high, But our emotional cycle usually prevents people from riding these cycles. So our job is to help make sure that we reposition the assets and communicate where you should be and where we think we are. And your job then is to communicate your ability and willingness to take risk so that we can appropriately reposition you on this cycle. Now, another thing to remember is that this is a cycle. This is going to happen again. So, we know this, we can manage through this. We've never had a cycle that went to a recession and a trough and never recovered. Okay. So sometimes it can be painful going through it, but it will cycle. And sometimes we're at the peak and the peak can last a long time, right? Just because we get to the top doesn't mean that we fold over immediately. And the same with the bottom. Just because we're at the bottom doesn't mean that we can't stay at the trough for a long time, right? So the duration of each of these cycles varies, okay? So what do we do about all this? What we do about this is that we use an economic cycle assessment, right? We're an institutional process. That's what we do. And so we have a market cycle survey that we take internally. Okay, there's 40 questions. You don't really have to worry about what they are, but we come up with a score. And so right now what you see is that we look like we're in that slowdown phase. We're scoring a bearish score of 26. The maximum score is 40. So right now we are 35% bullish and 65% bearish. And so you can see the red arrows pointing where we think we probably are in the cycle. Now remember, if I asked you, hey, what would be the best? You'd say, hey, I wish we had scored 40 bullish, right? We were 40 green. We were 100% bullish. Well, remember, if we were that bullish, that would mean we were probably at the top like a C or an H, okay? And that would probably mean that we were ready to go back down. So you got to be careful. Again, I know you're going to feel really good, but when we get to a bullish score of 40, really watch out, okay? And when we get to a bearish score of 40, really get ready for the market to recover. So that's where we're at on the economic cycle. That's one way that we try to assess where we're at. Now, what causes these expansions and contractions in economic activity? Monetary policy, fiscal policy, business investment, consumer spending, external factors, right? So in the bottom left, you see the Federal Reserve and the way it works influences the economy and the cycles. The money supply affects that cycle. Up at the top panel, we see this is the Bloomberg Financial Conditions Index, right? And so right now it's green, it's a little bullish. What we have here in the middle is the Fed funds rate. As you obviously know, it's been going up, and that's been pulling up that 10-year Treasury and the mortgage rates. And so as the Fed raises rates, the market slows down. As they lower rates, they'll start to come back down. So that's what's causing the cycle. Now, we also do a market cycle assessment, right? There's a difference between a economic cycle and a bull and bear market. So if you think about the economic cycle, it's more of the long-term strategic factors. You can think of the market cycle assessment as more of the short-term tactical factors. And so right now we are 85% bullish and 15% bearish. And that makes sense, right? Because remember how I said if we were really bearish on our economic cycle, that might be the time to get excited about the market and vice versa, okay? And so market cycles and economic cycles can diverge. What if the market is looking ahead, right? And so that's what we think is happening right now. You want to buy low and sell high. And so the market is looking past the recession, past the economic data to the recovery and expansion. Now, is it a little too early? Maybe it is, maybe it's not, but that's where we're at right now, okay? So all we can do is assess the data. We can't time the market. We can't predict the market. We can't predict macro factors. All we can do is take the data and analyze it to make better decisions, right? We got to look at all the critical facts, and then we can apply our research and adjust our portfolios. So you've seen this chart before, and it's because this year in 2023, people thought we should be very defensive, and you'd be in defensive sectors. And so, you'd be in sectors that typically do well, like utilities and telecoms and healthcare and financials. And of course, that's not been this year, right? What's been working are really those early and mid-cycle sectors. And so if you think about it, if the market's looking forward and our short-term tactical market assessment is bullish, is it looking past? It might be, okay? Again, is it early? We don't know. But right now what's been working is technology, staples, and discretionaries. So those have been the top 3 sectors for the quarter. And so those 3 sectors are above the S&P 500. On this chart, again, if we want to look at what's in those, it tells the story, right? Under communication services, you've got Meta and Alphabet. Under consumer discretionary, you have Amazon, Tesla, and then under technology, you have Microsoft and Apple, Nvidia, etc. And so those are the stocks, right? We're going to look at this further in a few slides. These are the handful of stocks that have been really driving the market. So again, to remind you, our value proposition as an active manager is really to build prudent and robust, purposeful portfolios by blending research, by blending quantitative methods, fundamental analysis, dynamic modern portfolio theory. We're willing to short the market, short bonds. We're willing to be long. We're willing to go to cash. So we're willing to hedge when necessary. Now, remember, anytime that you hedge, as I always warn you, that we're half right and half wrong. So if you were half stocks and half bonds all the time, and they were negatively correlated, meaning one goes up while the other one goes down, you'd always be winning and always be losing. Okay, so we're not ready to call let's just jump into all equities yet. We're still have a conservative outlook, which we'll share with you today, but we are in a better position than we thought we would be at the beginning of the year. Okay, let's review the markets. So the very first thing we're going to look at is supply and demand. Supply and demand drives everything, right? If there's more demand and less supply, prices are going to go up, and that's how it works in the market. And so what we're seeing right now is that the black line is up, which is the buying power. So the buying power has been in favor. So selling pressure is down. But you can look that since the beginning of the year, it's really oscillated, right? It was the black line was up, then the red line, then the black line, then the red line, then the black line. So again, you can see the cycle there. There hasn't been a long trend this year. It's really been an oscillating market. But right now, it's important to understand that the buyers are in control of the market at this time. And when we look at the breadth of the market, out of the S&P 500 stocks, 311 were up last quarter and 199 were down. Okay, and it had a great run of 15.91%. But as you can see here, the majority of those returns are being driven by Apple, Microsoft, Nvidia, Amazon, Meta, Tesla, Alphabet, Broadcom, right? It's been a handful of stocks that have been really driving the market. So breadth is starting to pick up. Again, it's not as bad as it might appear because there were 311 stocks that were up, right? So that's more than half of the S&P 500. But again, the large cap bias, right? The larger caps, the bigger companies will carry more weight in the index because that's how it's created. So it is true that the top 7 stocks have been driving the market, but there has been more breadth than I think people realize. So here we're looking at about 150 different asset classes. And again, you can see that tech and transportation and consumer discretionaries, and those are the names that we're seeing that are performing well. Here you can see the S&P 5 index. So it's been ahead of a lot of different asset classes. And then of course, down here at the bottom for the quarter, we can see the gold and we can see silver and we can see utilities and healthcare and some of the things that we thought might have been doing good if we were in a defensive sector. So for us, our ESG had a great quarter. Our focused blend is almost 12%. Our faith base is doing well. Our focused value. Metals is down, right? Metals is that counterbalance to equity. So we would expect it to be down when equities are up. So it's doing what it's supposed to be doing. Focused growth had a great quarter. Again, focused growth has been plus or minus the S&P 500, but we're holding 25% cash. So we're really mitigating that downside risk, okay? Dividends have been out of favor and real estate has been okay, and it's starting to come back over the quarter. When we look at the sailboats have been shorting the market, which has, the market's been up and down, up and down, and up and down. So there's been a little bit of whipsaw there. We put the cash back to work in those, and they're actually coming back strong as of this recording. The returns now on the aggressive are over 5, almost 6%. So they are recovering well, but because they're hedged, right, those are the portfolios that we would expect to kind of be at zero because they're more of an asset protection. Remember last year, these portfolios, the moderate portfolio was down about 4% when the market was down 20. Okay, so these are built for those downside markets and they will lag and underperform when the market is going up. The speedboats have done well. They're a little more traditional allocation. Okay, so they're built and they've recovered since the end of the quarter. They are leaps and bounds ahead as well. So there's been a lot of change since the end of the quarter. Our tugboats, again, are dynamic risk models. They're right in the middle. Again, they're trying to manage risk and they are doing what they're supposed to be doing. Okay, let's change our attention to a recession. What drives the recession expectations? We kind of went over some of those macro factors, but we don't know when, if, how long, how deep, or what the Fed will really do. We have indications of what we think they'll do, but we really don't know. So let's just look at the data and we can form our own opinions. So you've seen this chart before. What we think is a pretty good predictor of a recession is the change, the 1-year change in unemployment. So not the pure level of unemployment, but the rate of change in unemployment. And so again, you can see that blue line that when it goes from 0 to 1, it usually is followed by a red line, which is a recession. So we're at 0 right now, and we're waiting to see if that change goes up. And as you're going to see, we do expect unemployment to continue to rise. When we're looking at the recession models, the top chart is the S&P 500. It's just to show you how the market's performed under these recessions. And the middle box, the white line, is the probability of a recession over the next 12 months from the New York Fed, and it's at 67%. I'll just point out that our independent work shows what? We showed about 65% from our market cycle assessment. And then the Bloomberg model has a 100% chance and says we're already in a recession. The Fed model is based on the difference between the 3-month and 10-year Treasury, which we see is a negative spread. And we know that's a very negative indication. That is a strong indication of a recession. And that also contributes to the inverted yield curve, which we'll talk about in a moment, which is another recession indicator. A lot of people like to look at the leading economic indicators, and you can see that they're down, okay, come down substantially. And so that is a warning sign for a recession. But the interesting thing here is that I've overlaid the standard deviations. Okay, so here's the blue line is average. Here's 1 deviation up, 2 deviations up, 1 deviation below, 2 deviations below. And so remember how I told you earlier that your emotions are disconnected from the cycles, and that if things are really, really, really bad, it might be giving us an indication that they're going to start turning around. Well, we kind of see that here as well. Again, this doesn't mean that we won't have a recession, but this indication is almost at its second deviation point. If this reverts back up to its mean, that means that we're going to start to see that recovery, okay? So the farther it is down here, the more likely it is to go back up here. The higher it is up here, the more likely it is to come back down here, okay? And we can see that. So again, as things get worse and you get really worried, that starts to hit the point of capitulation where things might turn around. I'm not saying we're there yet, but this is the data that we're looking at. When we look at the recession model from Bloomberg, they go out and interview and survey all the banks and economists out there, and their mean indication is a 61.8% chance of a recession. So again, we're in those mid 60s across multiple readings, and so that's where we're at. Doesn't mean we'll have one, but that's where the numbers fall. When we talk about the Fed contracting, again, what we really need to look at is the forward-looking economic data, and that comes from the ISM indexes, the Manufacturing and Services Index, or non-manufacturing index. So remember, the GDP is a backwards-looking indicator. That's when we're looking through the rearview mirror of the car. But if we want to see where we might be going, we have to look out at the windshield of the car, and that's why we turn to the ISM indexes. And so you'll see here that anything above that dotted line, 50, is positive, and so we can see that the services index is at 53.9, so that's still in an expansion area. Anything below the red line is a contraction, and we can see that the manufacturing index is at 46, it's below 50, it's in a contraction area. Now, when we look at the bottom chart, that's the Fed funds rates, and you'll notice that we can have economic activity fall into in a contraction area and still have a soft landing. Other times you'll see that economic activity has dipped, and we see a red circle on the bottom chart there with a red bar following, and that is a recession. So again, the Fed raises, they break it, they pause, and sometimes we're going to have a recession, okay? When might the Fed pause? Well, they already paused last month, but they said that they're going to continue to raise. And we look at the data here, we see that the core PCE, which is their favorite metric of inflation, is at 4.6, and their Fed funds rate is at 5. So their Fed funds rate is now above inflation, and that should start to slow it down. So a pause, they're probably not quite done according to their own admission, but they're probably getting really close to that. Again, they did already have a pause. When we look at the Taylor rule, when we look at the math that says where should we be, what we're going to look at here is we're going to look at this inflation, the core inflation, the unemployment forecast, and the Taylor rule. And this is what it says the rate should be. And this is where the Fed funds futures, which is a live trading indication, a price discovery mechanism of where the market thinks rates are going to be. And so As I mentioned a slide or two ago, you can see that this unemployment forecast is increasing, okay? So we can see inflation is continuing to come down. So that's the right direction. Inflation is coming down. But over here, we do see unemployment going up. That's kind of what the Fed wants. And if these come true, this is kind of where the Fed funds rate might be. And so you can see the chart on the right that, the Fed funds rate in the orange line is starting to pause. The Fed futures are believing it. The white line's really close to the orange line. And that's how we read that data. So again, we do expect unemployment to come up a little bit. We expect inflation to come down. And as we can see here, the Fed funds rate looks like it can stay paused. It'll go up and then start to come back down. So what we've been seeing is a great rally, right? Anytime the market is anticipating a pause, it rallies. So we're a little bit ahead of ourselves, right? The market's been rallying all year, okay, but the Fed has still been raising, but the market has been hoping that the Fed will start to pause. And so they're trading on the future expectation, okay? And so it's always looking forward. And so right now we see that the market's had a great run, even though the Fed has been raising, because they've been anticipating that pause in June, and they're anticipating maybe a rate hike or two this year, and then a pause and maybe starting to have that rate fall. So again, the market's looking past that. And so if a recession comes, if this economic activity does dip into a contractionary area for too long, then we could see a red bar. We still could see that recession. So just because the market's rallying doesn't mean that it will continue. It could definitely pull back if a recession hits. In fact, if a recession hits, it will pull back. Okay. But right now, it's in a good mood. Okay, what drives the market? We've looked at this many times. Inflation, interest rates, corporate earning, the Fed, and then of course geopolitical events. So right now we see that inflation's been coming down. It's getting closer to the Fed mandate of 2. We don't think it'll be there for a while. According to the University of Michigan study, it's going to stay at 3%. On this middle bar, the next year's expectation is at 3.3, and the CPI is at 4. But they're all coming down, and that's a positive indication. When we look at that Treasury rate, we saw that great run up, and that's what caused rates went up and the markets went down. And now we're starting to see it level off. Okay, so it's been leveling off. It's come back up. We expect it to continue to oscillate, okay, but it doesn't look like we're going to see another steep run up in that 10-year rate. When we look at the yield curve, it's inverted, right? This green line should be going from the left to the right of the chart. It should be an upward sloping concave shape, meaning that you get a higher interest rate for the longer you have to lend out your money. That makes sense, right? When you buy a bond, you're a lender of your money. And so if you lended money to somebody for 30 years, that would bear a lot more risk. You might not get paid back. A lot can happen during that time. And so you'd expect a higher rate. Well, what we're seeing right now is the opposite of that. When we look at the 2-year Treasury yields and the Fed funds rate, again, you can see that they're almost back to even. So again, this is where the Fed needs to be able to buy low and sell high. So the Fed funds rate is this blue line, and the 2-year is the orange line. And they're almost back. We would like to see that orange line above the blue line. So as rates continue to hold or come up and the Fed funds pause or come down, we can get that relationship back into a positive territory. The reason these rates matter is they all go into valuation. So you're probably looking at this and going, wow, there's so many charts and data. So just remember, the higher cost of capital, the lower the valuation. So the lower the valuations means lower stock prices. The higher the valuations means that we are going to have higher stock prices. So that's why we're looking at all the components that go into that valuation proposition. Again, I know I'm building some clocks here, but hopefully we can tell you what time it is as well and keep it simple for you. When we turn to earnings, we see that on the bottom, the green line is the trailing 12 months earnings on the S&P 500, and currently that's at 223. The best expected earnings are at 217, so that is a earnings contraction of about 3%. The confusion will come in that when we look at market consensus of where the stock market is and where the analyst estimates are, we're looking at a positive 9.6%. We're looking at the index right now at 43.98 going to 48.19 as of this date. And so that's a positive return. So how are we going to get there? If we have not quite a 2% dividend yield and a 2% negative growth, that's zero. So how are we getting to a 9% return? That would have to come through that PE expansion multiplier effect. Okay, so what's our outlook? Well, we're neutral. We're very hopeful, but we're concerned, right? As you know, we've been arguing that we could argue that the market's going to go up, and we can argue equally well that the market's going to go down. So right now we have put some more cash back to work, but we can pull that back in our portfolios as appropriately if necessary. And so we're really neutral across the board. We're not out of the woods yet. The market's had a great year, but again, we're not out of the woods, so we're still cautious. Going forward, again, nothing's changed. We're expecting lower long-term returns from assets. Risk and inflation will continue to battle, although the inflation is coming down. Okay, and we don't want to fight the Fed. A pause came, but hikes could be back. That 2 year still lower than the Fed funds, but improving. So again, we're working our way through this, right? We're working the problem here, and we're not out of the woods, but we're getting there. Interest rates are inverted. So again, that's a negative indication and a good representation of a potential recession. There's definitely increased opportunity for active management, right? This is not the year you just want to buy and hold an index. This is the year that you definitely want to active manage. As you saw, the top 10 stocks out of the S&P 500 have been driving the majority of the return. So our focus strategies are in favor. Okay, that stock selection is important, but we also have to have patience. Remember last year, those same stocks that are leading the market last year were leading the market down last year. So the same stocks that led the market down last year are leading the market up this year. So you have to be patient, right? The second half of 2023 has room to run unless that recession does hit, there's a geopolitical event or the data changes, but the mood in the market is becoming a little more bullish, and sometimes that's a contrarian, right? Sometimes that's a tell that maybe we should be more bearish, but that is what the consensus is. Risk management has been popular, right? As we look out with all these geopolitical risks that we've been facing all year. However, it's been risk on assets that have been winning. And so that again doesn't feel good, right? When you think that there's a recession, you think there's a lot of bad economic news, the Fed's going to rate, inflation's going up, and so you become more conservative. That was the right decision. But unfortunately, risk on assets did prevail. So for people that got too conservative, you should feel happy. You didn't make a bad decision. It's just that, you always have to reposition your portfolio based on your willingness and ability to take risk and with the data that you have at hand. No one can foresee the future. So again, risk on has been in favor, but you still maintain cautious. Again, corporate earnings have been resilient, but stay tuned. That money supply is coming down drastically. So we could see an earnings recession still hit. And the positive point there is that remember, the market usually bottoms before earnings. Okay, so that's the hope that we have. Remember, we said we're hopeful, but we're still concerned, right? That's two sides of the coin. The banking crisis fallout, big question mark, right? Yeah, it looks like it's maintained and contained for the moment, but we'll just have to wait and see how that works out with the smaller and regional banks. So what should you do? Hold enough cash to make you comfortable. Evaluate your time horizon and your other factors that build your investment policy statement, right? Make sure you know your required return, your desired risk, your time horizon, your liquidity needs, your taxes, any unique circumstances or legal factors that you might be facing that could constrain the portfolio. And then make sure to communicate those changes to us and your team so that we can make sure that we've got your portfolios positioned appropriately for your life. Remember, and everyone's different, right? So there's not a one way fits all. It's all uniquely built for you and your family. Again, be patient. We're working through it, right? And so we just have to be patient. Don't panic. What are we going to do? We're going to continue to manage cautiously. We're going to monitor and adjust. We're going to continue to communicate. Again, as analysts, that's what we do, right? We investigate, we analyze, and we communicate. Real quick here for part two, for people that want to stick around for that, we just see here growth has been in favor over value. And so that's been oscillating a little bit, but growth has been in favor for most of the year. We see here that, again, that white line is the S&P 500 growth, the orange line is value, and the yellow line is the S&P 500. Large cap's been in favor over small cap. We're back to a market cap weighting has been in favor over equal weighting for most sectors, definitely at the market level. There are some sectors where that equal weighting has been in favor, such as energy and healthcare. Technology has been market cap. It's real estate's been equal weighted. So we are having a mix, but at the market level, it's been a cap weighted market. When we look at the fundamental factors of where we might be going from the sectors, energy is still number one with telecoms, materials, and financials and healthcare. Again, those are your defensive sectors. And so remember, those are the sectors that haven't been doing well. But when something's down and it hasn't been doing well, that creates more value. So when we're looking forward, there's much more value to be had in those sectors than there is for a sector like tech that's really had a great year and run, right? So remember, you have to think buy low and sell high. What's done well may not continue to do well in the future because it's run out of value, it's run out of steam, and that might be the time to rotate into a sector that's been out of favor but looks attractive fundamentally. Remember, buy low, sell high. When we look at the VIX is just a measure of the fear index, right? And so it's volatility. And based on a daily move, the next 240 days on the VIX, we looked at a move on the market of about 14.5%. Based on the volatility of the S&P 500, it's 10, so somewhere between 10 and 14%. Now remember, we don't know which way that's going to go. That could go down. So if a recession did hit right now, VIX would start to increase, but as it stands today, that range would be, within one deviation, up or down 14% or up and down 10%. We look at asset allocation. Right now, 90% of the time, we expect a maximum Sharpe ratio portfolio, a risk-adjusted portfolio, to be between negative, let's call it 8% and 23%. And on average, it's about 7.5%. So that's where we're sitting with asset allocation expectations. So thank you so much. I know that was just a little bit over than a half an hour, but we really appreciate you taking the time to watch our video today. Of course, contact us with any questions or concerns. We love to take your calls. So again, my name is Joe Mass. I want to thank you so much. Have a great quarter. Enjoy your summer, and we'll talk to you soon. Thank you.